The profit and loss statement. The profit and loss statement, also referred to as an income statement or cash flow statement, provides a summary of a business's financial performance over a time period such as 12 months. In simple terms, the profit and loss statement lists the total turnover or revenue or total money into a business at the top of the summary, with expenses deducted from this amount, until the final amount at the bottom of the summary, which is also known as the bottom line, is revealed. This amount on the bottom line requires no further deductions and is considered the owner's net profit after tax. The following is the first portion of the profit and loss statement for a hypothetical small business. As can be seen in this summary, sales, which can also be referred to as revenue or turnover, is listed at the top of the summary. This is the total amount of money collected by a business in a 12-month period. The first deduction from this amount is the cost of sales or the cost of goods. If we assume this business to be a clothes retailer, then the cost of sales or cost of goods are the clothing items purchased from suppliers for sale to retail customers. The cost of sales can be calculated by adding the beginning stock, which is the stock that remains unsold from the previous 12 months of trade, to stock purchases, or clothing that has been purchased during the current 12-month trading period, before finally subtracting ending stock, which is the stock that remains unsold from the current 12-month period of trade. In the example provided, the beginning stock, or $40,000, is added to stock purchases, or $660,000, to obtain a figure of $700,000. Ending stock, or $100,000, is then subtracted from this amount. This is reflected by the brackets, which refers to the number as a negative number. Once this process is completed, we arrive at our cost of sales or cost of goods figure of $600,000. This amount is subsequently taken from the sales figure of $1 million to arrive at a gross profit amount of $400,000. The second portion of the profit and loss statement relates to operating expenses, or the day-to-day expenses incurred by a business to keep trading. These expense amounts are taken from the gross profit amount of $400,000. These operating expenses include salaries. This includes any salary that may be paid to the business owner or owners, as well as superannuation and other on-costs such as workers' compensation. Wages, which are typically for casual staff and include superannuation and on-costs such as high levels of pay for out-of-mainstream business hours employment. Marketing, such as television or letterbox drops. Occupancy, which include rental costs or principal in the event of a business property being purchased by loan. The principal portion of a loan repayment relates directly to ownership of the property, with the interest portion of a loan repayment relating directly to the cost in servicing the loan. Administration, which can include stationery, phone costs, accounting and legal expenses. Depreciation, which is the decrease in value of plant and equipment used operationally within a business. A simple example of depreciation is for a food business that purchases a 6-burner oven for $3,500, with the 6-burner oven having a lifespan of 5 years. This means that in year 1 of ownership of the oven, the value of the oven is considered to be $3,500. In year 2, the oven depreciates in value because of use and is now considered to be worth $2,800. The plant continues to depreciate at $700 per year until the end of the 5-year term, when the plant is considered to have zero value. The operating expenses conclude with an expense for interest for loan servicing. In this example business, we can see that these operating expenses add for a total operating expense of $310,000. This amount is deducted from the gross profit amount of $400,000 to arrive at a net profit value before tax value of $90,000. The final portion of the profit and loss statement relates to provision for income tax and net profit after tax. The provision for income tax is an estimate of the tax liability of the business and is calculated by an accountant. This amount has not been paid by the business, but is expected that it will be paid within the next reporting period. The final part of the profit and loss statement, which is also known as the bottom line, is the net profit after tax, or the cash profit of the business over a 12-month period. This is the amount that the owner or owners can distribute. If not distributed, these amounts are retained by the business and are referred to as retained earnings.